Good morning all, and thank you for taking the time to listen to this webinar. As Franz mentioned, by way of introduction, my name is Tapiwa Ngwena, and I am an investment strategist in the SPDR ETF team, focusing on equity sectors. So today I really want to delve into the issues which have been driving markets and share some ideas about how you as investors can actually navigate the current issues which we're facing. So we'll take about half an hour or so, and I really want to address three key questions. So the first one is, why have equity markets been so resilient in the face of the uncertainty and issues which we've seen in the market? The second issue which I'd like to address is what has been driving equity market returns this year. And finally, bringing these two concepts together, I really want to touch on why sector investing can be beneficial to you as investors in the current market environment. So pretty much to set the scene, the first slide shows the cross-asset class performance for 2017 up to the end of July. And really, the reason why I highlighted this to start with is you can see that returns across asset class have been really strong and irrespective of the issues which we've actually seen. In general, what we can see is equity markets have posted strong double digits, with emerging markets being the standout performer. And I thought this is quite interesting when you think about it, because if you were to stand back at the start of 2017 and you were thinking about what was on the calendar at that stage, where we just had Trump as the president, we had the Dutch election on the horizon, the French election, and we also had the UK snap election, which was called. One would not have thought that equity markets would have been this strong when you look at where we are right now in the market. So this has really been a discussion point which we've been with investors, and I just want to expand a bit more on maybe some of the key issues and concerns which have been highlighted. So just pointing out a few asset classes. In terms of the weakness in commodities, as we know, this has really been linked to the weakness predominantly in oil, and that's also affected certain parts of the market. But apart from that, it's really been strong performance in both equities and fixed income. So that definitely poses the question as to why have markets ignored geopolitical risks which have been on the horizon. So the slide which we have here highlights two measures of risk which investors tend to look at. So you have the VIX, which is a measure of implied volatility, and this is the dark blue chart on the bottom, I'm just highlighting, and you have skew. And what skew does, it measures let's say the probability of tail risks happening. So what we've noticed is, if you just right at the end of this chart, you can see that volatility levels have been really subdued, as in they've been really low in 2017, which is contrary given the risks which we've seen, and we've also seen the war of words between North Korea and the US, and yet the actual implied volatility in the market has been low. And we think the reason for that is all of these issues have not posed systemic risk to the market. So what systemic risk is where you tend to have events which trigger broad market sell-offs and affect asset classes across the board. So we've seen events happening, and they've really affected isolated parts of the market. However, when you look at skew, which is the blue chart on the top, what you can see is this is elevated, and it's elevated below, above its long-term average. And as I mentioned earlier, what skew measures is the likelihood of tail risk happening. So you can see, in as much as volatility has been low, What the market is looking and observing is there is a likelihood of a tail risk which would actually derail the markets, which leads us on to the next question, which is, are investors complacent? And we don't think investors are complacent. As we just pointed out, the implied probability of a tail risk happening is high, and I think investors are conscious of that. The chart which we have here shows a measure of investor confidence. So this is a proprietary measure by State Street, where we look at the buying and selling pattern of institutional investors to get a gauge of the risk appetite. So what you can see from the bold blue line is, yes, there's an appetite for risk assets, but it is not as elevated as we've seen in previous years. So we do see an appetite for risk assets, although this is relatively contained. When you dig a bit deeper, which are the dotted lines, and you look across the regions, we do see some differences in behavior, where you have Asian investors and European investors starting to pare back on their risk appetites, whereas North American investors still showing positive risk appetites. But on the whole, what we see is investors are not exuberant, so they're not necessarily chasing returns and overstretching their allocations at this juncture. This leads us to ask, what are the supporting pillars for investors to continue looking at risk assets, and in particular equities? And I think one of the key things when you think about equities, they're a level of economic growth. So whenever you have a sound economic growth background, that tends to be supportive for equity investing. So if you turn initially to PMIs, which tend to be a slightly forward-looking indicator of growth, what you can see here, we've charted the manufacturing PMIs across the three main regions: emerging markets, the Eurozone, and the United States. So all of these measures are above 50, and what this tells us is we're still in expansionary territory. So the first message is, I think that is still reassuring from a growth perspective. You have, if you look at the individual charts, the pace of growth does differ between the regions, where you see a bit of momentum slowing, let's say in the US. However, what's really reassuring is we're still in expansionary territory, which means the overall growth is still on a positive trajectory. Taking the economic backdrop a step further, we looked at capital formation. And what capital formation shows us is this is the actual real growth in the economy. So real gross capital formation measures all the accumulated growth in the capital base. And what this shows us is the capital base has actually been growing in both the US and in Europe. And this is the real growth which matters for businesses. As we mentioned earlier, equities or corporates tend to lever economic growth. So when we actually see the real economy starting to grow, this is reassuring for equity markets. So just to recap, from the backdrop which supports equity is still very robust, and we actually think this has been a reason why markets have shrugged off some of the concerns which we've seen surrounding political events and some of the geopolitical tensions. Just so looking in terms of the actual equity drivers, I think the first concept is there's been a thematic trend where we see investors beyond fixed income. And what this chart shows us is we've charted the three regions, so the US, Europe, and the UK, and we've shown the difference between the equity market and the bond market. And what you can see, particularly for Europe and the UK, there's still a positive yield gap in favor of equities, and this has also supported flows or investors allocating into equities. In the US, the gap has closed recently, and although it's closed recently, when you actually dissect the markets, so when you look at different parts of the equity markets, there are still areas which yield more than the bond market, and this also supports investors who've been looking at equities as an alternative source of income. But really turning to the drivers of equity markets in 2017, what we have done is we have decomposed the equity returns. So the chart on your top shows the breakdown of equity returns by dividend yield, multiple expansion, and earnings growth. So the dividend yield is obviously the yield from the dividends which the companies are paying. Multiple expansion shows us how much of the price return is driven by valuation ratios inflating. And earnings growth is where you actually see the real earnings of the company starting to drive the returns. So when you look at the charts, so we've charted it all the way back for about 40 years, you tend to see the two main drivers are either multiple expansion, which is your dark blue line, the dark blue bar, or earnings growth, which are these light blue bars. So more recently, when we look at 2017, is we've actually seen multiple compression. So we're no longer seeing multiples really driving returns, and it's really been driven by earnings growth. So just zooming into the year to just 2017, we've looked at the key equity regions, and we've done a similar breakdown just to show the returns have actually been coming from in 2017. And as you can see from this chart, it's really across all regions, we are starting to see earnings growth. So this is, once again, it's reassuring that we're no longer getting either macro drivers or monetary policy, which has been eating multiples driving the markets, but we're starting to see corporate earnings being the main driver of equity returns. So once again, it's reassuring, but it also means as investors, you really now need to understand where the earnings growth is coming from and how best to position yourself. So since earnings are important, on the slide we just recently completed at the end of July the second quarter earnings season, and this is a quick summary. We've just picked up the US market, and what the two charts show us are on the y-axis, they show either a measure of earnings growth, so blended EPS is earnings per share growth, and on the adjacent chart, this is the number of companies which actually beats analyst expectations. So both of these are showing an element of where the growth has been coming from, and also the surprises have also come from. So I'll just highlight, let's say, the area which you need to focus on in last quarter, because seeing the most growth coming from cyclical sectors. So the cyclical sectors are the ones which are more sensitive to the economic growth and let's say positive growth and environment. So it's really seeing earnings growth filtering through in industrials, materials, and technology has really been the standout performer. And also which beat analyst expectations, we see a slightly similar trend with most of these are cyclicals, with the exception of healthcare. So once again, technology, despite all the I guess the strong performance which we've actually seen in technology, we're still seeing it surprising on the upside in terms of both earnings growth and also the growth which they're delivering. It's above investors' expectations. What we also did is, particularly for the US, because the weak dollar has played into corporate earnings, we also charted this against foreign sales, because this was a big theme in this most recent quarter, where companies which had slightly higher foreign sales, and what I mean by foreign sales, these were for the American corporates, their revenues generated outside the US. Those companies which tended to have a higher proportion, they tended to benefit a whole lot more in terms of their actual earnings being boosted. So this actually leads on to, when you think about earnings being a key driver, understanding what parts of the market the earnings growth are coming from, and being able to position yourself as investors in those parts is something which is beneficial. So I'll now turn to why sector investing makes sense in this current environment, and really tie together both those concepts which I've highlighted in terms of the robust economic growth and also earnings being the key driver of markets at this juncture. So looking at sector investing, I think the features which make it attractive for investors, it tends to be the flexibility. And what I mean by flexibility is what sectors allow you to do is you do not have to buy the entire market. So for example, the S&P 500, the MSCI Europe, or the Euro stocks, you can actually pick the parts of the market which you believe will actually outperform. So it gives you choice and flexibility as an investor, and particularly as we've seen more recently where different parts of the market behave differently, that flexibility has really been popular with investors. The second aspect is targeted risk. So what we have in sectors is you group companies of the same industry together. So each sector tends to have a slightly different risk and return profile. So this allows you as an investor to actually target the risk which you'd like to take. So for example, if you wanted higher beta sectors, so there's some sectors, for example, financials, which have slightly higher beta, sector investing actually allows investors to take targeted risk in the parts of the market which match their risk budget. And the last element is thematic. As we highlighted earlier, technology has really been a strong performer. We've seen a lot of innovation and growth in technology. And what sector investing allows you to do is also pick out those sectors which are aligned to the themes which may be relevant in the current backdrop. So these are the key features which we've seen investors really find useful and attractive. And what I'll just do now is expand or explain two of the concepts which are really helpful from a risk return perspective. So the first element is all about dispersion. So the way we'd look at dispersion is winners and losers. So what this heat map shows you on the slide is the performance of the S&P 500 from 2011. And the actual S&P 500 is highlighted in yellow. So you can see across the board, the S&P 500 has had positive returns since 2011. But when you break it down from a sector perspective, you can see that the winners and losers have been constantly changing from year to year. So the technical term which we referred to this is called dispersion, when you look at the top performer and the bottom performer. And what we've really seen is a widening gap between the top and bottom performer. So for example, year to date in 2017, the difference between the top performing sector, technology, and energy, which was the bottom performing sector, is roughly 30%. And as investors, that means selecting the right sector can be a source of positive alpha or source of outperformance, which is a benefit of sectors. So you can actually identify the parts of the market which you want to be positioned in. The second aspect which is beneficial when you look at sectors is this aspect of correlation and the diversification benefits. what we've seen recently over the last couple of years is we've seen a fall in the pairwise sector correlation. So this means the individual sectors are starting to behave differently. So the benefit to investors is this provides potential for diversification. So you can see from the matrix here is there's really a wide range of correlation, let's say, between the sectors, and some of them are actually negatively correlated with each other. So it allows investors, you can actually diversify away your portfolio. So if you had a portfolio, you can use sectors with, for example, either a low beta, utilities as an example, just to either diversify your portfolio. So the message here is another practical use which sectors can also provide is really that diversification benefit given the fall in correlations. So bringing these two concepts together about dispersion and falling correlation, we really look at this in terms of being able to invest through the business cycle. So academic studies, what they've shown is there is time varying premium in the different sectors, which is linked to the phase in the business cycle. And what that means is different sectors tend over the long term tend to perform differently or are more or less sensitive depending on the parts of the business cycle. So for example, in times of recessions where basically you've got slow economic growth and overall corporate earnings are a bit slower, companies with more stable companies with stable revenue streams, for example, utilities, which are less sensitive to the economic cycle, because we all still need to serve, let's say, to get water, electricity, and gas, irrespective of what the economic background is. So the return and revenue profile of these businesses tend to be stable throughout the business cycle. And what you tend to see is when you're in a slower part of the business cycle, these sectors tend to perform better because their earnings are less linked to the overall growth. And literally what this chart shows us in all the different phases on average, these are the sectors which tend to perform well. And how investors would use this is they would do a top-down analysis of where they think we are or where they think they are in the business cycle and identify the sectors which best fit that environment. So sectors can be a good way to play the theme and also invest throughout the business cycle. So just to have a look in terms of where the money has been flowing, I thought would highlight from a ETF perspective what we've been seeing. So what this chart shows us on the right, we have the flows prior month and year to date across the different sectors. And what you can see is even in terms of the flows which have been coming into the markets, investors have actually been differentiating where they're putting the money to work. So for example, in July, the strongest sector which we saw inflows was financials, which had about 1.6 billion, and materials as a whole, from an industry perspective, saw about 1 billion of outflows. And obviously materials, that is linked to the weak commodity markets, which we've seen. So you can see some of that positioning of investors pulling money out of that sector. And in terms of financials, the increase in yields has benefited financials, and it's one area where we've seen investors position themselves. So we can really see this in the market where investors start putting money in parts of the market which they actually believe will benefit depending on the economic backdrop. So just to recap, sector investing has a number of key benefits in terms of dispersion and correlation, which can help investors either find alpha or diversify their portfolio, as well as investing in the economic cycle. So what I just want to wrap up with is giving an idea or sharing one of our picks of which we like, and I'll just explain to you the reasons why we like the sector and how it sort of ties in with the current economic backdrop. So the sector, one of the sectors we like, just looking at the world sectors, we like telecommunications. So telecommunications is an interesting sector because this year in 2017, it's mainly been out of favor and undervalued from a valuation perspective. And I think really to understand why that's been happening, it's really the chart which is on your left, where I'm just clicking on. So what this chart shows us, this has really been the change in, let's say, mobile subscribers and fixed line, as well as the growth in internet. And what we've seen in recent years is we've seen a really big fall in terms of landlines. So like most of us, we now rarely use landlines. So there's been a really strong drop. And at the same time, there's been an increase in the use of mobile. So what telecommunication companies have had to do is, driven by this technological shift, they've invested a lot in upgrading the infrastructure. And obviously, that's led to a lot of, let's say, costs incurred. The issue from an investor standpoint is we haven't yet seen, or we had not yet seen any return on all that investment. What we believe is we've reached the peak of the technology-led capital spending, and this increase in mobile usage and as well as data usage will start improving pricing power for telecommunications companies. And we think that improvement in pricing power is really what's being picked up in earnings estimates, which are showing an increase in earnings when you look at the coming years. So we're starting to see analysts upgrading their expectations for the sector. And we believe this is really driven by an improvement in pricing power, which will help with the margins and ultimately the bottom line of the earnings. The other thing about the telecommunications sector is it generates a high level of free cash flow, and that supports the dividend yield. So currently, the MSCI World Telecommunications sector yields about 4.2% in terms of dividend yield, whereas the actual benchmark index, which is the MSCI World, yields are half of that. So there is a yield story also behind telecommunications, and it's also a defensive sector, which helps given all the market risks which we're seeing. So we like it because it's defensive, it's got a good yield, and we think the fundamental story surrounding that capital spending and that return on that investment, the return on the investment is likely to start turning around. So these are really the key reasons why we like, let's say, telecommunications. We do publish monthly our dashboard, which is available on our website, spiders.com, and it shows all our picks for the current month, as well as our reasoning and why we actually like the sector. So, now, in conclusion, just to wrap it all up, we think the reasons why markets have been strong has really been driven by the recovery in the real economy. And this is positive for equity markets. Obviously, as we mentioned, going forward, investors need to be a bit more cognizant of the risks, but that underlying economic growth is a strong pillar, which we actually think will support markets going forward. The fall in correlations means that differentiating between sectors is actually important, because the different sectors are starting to perform differently. It definitely warrants investors to really focus on which sectors they think will perform in the current environment. And linked to that point is we've seen that earnings have really been the key driver for equity markets. So we actually think earnings are going to continue to be a driver for markets in 2017. And understanding what parts of the markets are driving this growth is going to be key for investors. And what sector investing and sector ETFs allows you to do is it allows investors to be nimble and pick the parts of the market which they believe will actually deliver the growth or perform well in that environment. Thank you.